Today, the RBA Crunch continues. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. So Australia is on track for its steepest tightening of monetary policy in a generation, raising the risk of an economic slowdown as the housing market shifts into reverse and consumers pull back on spending. At its meeting today, the board decided to increase the cash rate target by 50 basis points to 1.85%. And it also increased the interest rate on exchange settlement balances by 50 basis points to 1.75%. That means it'll be taking a combined tightening since May to 175 basis points. That's the biggest increase inside 6 months since 1994. The RBA is behind the pack, said Andrew Ticehurst, senior economist and rating strategist at Nomura Holdings. The current cash rate is not appropriate for an economy with an unemployment rate of around a 50-year low, and with core inflation running at a 6% annualised pace. Ticehurst sees the cash rate at 3.35% by the year's end, while money markets are pricing in about 3%. Such a sharp pace of tightening will ratchet up repayments and weigh on consumption, which accounts for about 60% of economic output. Policymakers are trying to rein in inflation that's running at more than twice the upper end of the RBA's 2 to 3% target, and they maintain households can cope with further hikes because they build up savings during the pandemic, and 3.5% unemployment means most Australians have incomes to meet their obligations, except, of course, the distribution of those buffers is not aligned to necessarily where the debt is. RBA rate hikes flow through quickly to borrowers, as most are on variable rate loans, and a slide in property prices has accelerated since tightening began, with July data showing the key Sydney market fell 2.2%, its sixth monthly decline. Real estate data firm PropTrack expects prices will fall 15% from current levels in 2023, after climbing at an exceptional pace over the past 2 years. Wanted notices also fell in July and may have passed their peak, an Australia and New Zealand Banking Group Limited survey showed on Monday. Even so, ANZ economists see unemployment falling further in the months ahead to less than 3%, as the economy has to absorb all of the job vacancies still available. The labour market strength is a key source of confidence for the central bank raising rates quickly. But consumer sentiment has weakened in response to rate increases, and there are signs of cooling demand. Commonwealth Bank of Australia internal data, which tracks spending on credit and debit cards at the nation's largest lender, showed a clear easing in consumption in July. There is a clear risk that the volume of household consumption falls by late 2022, said Gareth Aird, head of Australia economics at CBA. We expect forward-looking indicators of the economy to slow sharply. And retail sales growth has slowed on rising interest rates and, of course, on inflation. Yet it's inflation which Australia's government expects to reach almost 8% by December, and that's concerning the RBA. The median estimate is for the cash rate of 2.85% by the end of the year. That's slightly lower than the money market bets of around 3% at the moment. If rates rise too quickly, it will cause a major problem for the economy, said Shane Oliver, chief economist at AMP Capital Markets, who sees the central bank pausing at around 2.6%. Oliver pointed to RBA analysis showing around 1.3 million households may see a 40% or greater increase in mortgage payments with the 3% hike in interest rates. This, at a time of falling real wages, will have a huge impact on spending in the economy and risks a significant rise in forced property sales. That's one reason why Nomura, CBA, AMP and UBS are predicting rate cuts will come as early as next year. Now, this is what the RBA said accompanying their announcement. The board places a high priority on the return of inflation to the 2 to 3% range over time, while keeping the economy on an even keel. The path to achieve this balance is a narrow one and clouded with uncertainty, not least because of global developments. The outlook for global economic growth has been downgraded due to pressures on real incomes from higher inflation, the tightening of monetary policy in most countries, Russia's invasion of Ukraine, and the COVID containment measures in China. Inflation in Australia is the highest it's been since the early 1990s. In headline terms, inflation was 6.1% over the year to June. In underlying terms, it was 4.9%. Global factors explain much of the increase in inflation, but domestic factors are also playing a role. and there are widespread upward pressures on prices from strong demand, a tight labour market, and capacity constraints in some sectors of the economy. The floods this year are also affecting some prices. Inflation, they say, is expected to peak later this year and then decline back towards the 2 to 3% range. The expected moderation in inflation reflects the ongoing resolution of global supply-side problems, the stabilisation of commodity prices, and the impact of rising interest rates. Medium-term inflation expectations remain well anchored, and it's important that this remains the case. The bank's central forecast is for CPI inflation to be around 7.75% over 2022, a little above 4% over 2023, and around 3% over 2024. The Australian economy is expected to continue to grow strongly this year. Employment is growing strongly, consumer spending has been resilient, and an upswing in business investment is underway. National income is also being boosted by a rise in the terms of trade, which are at a record high. The bank's central forecast is for GDP growth of 3.25% over 2022, 1.75% in each of the following 2 years. The labour market remains tighter than it's been for many years. The unemployment rate declined further in June to 3.5%, the lowest rate in almost 50 years, and job vacancies and job ads are both at very high levels, and a further decline in unemployment is expected over the months ahead. Beyond that, some increase in unemployment is expected as economic growth slows. The bank's central forecast is for the unemployment rate to be around 4% by the end of 2024, and their liaison program and business surveys continue to point to a lift in wages growth from the low rates of recent years as firms compete for staff in the tight labour market. A key source of uncertainty continues to be the behaviour of household spending. Higher inflation and higher interest rates are putting pressure on household budgets. Consumer confidence has also fallen, and housing prices are declining in some markets after the large increases in recent years. Working the other direction, people are finding jobs and obtaining more hours of work. Many households have also built up large financial buffers, and the savings rate remains higher than it was before the pandemic. The board will be paying close attention to how these various factors balance out as it assesses the appropriate settings of monetary policy. Today's increase in interest rates is a further step in the normalisation of monetary conditions in Australia. The increase in interest rates over recent months has been required to bring inflation back to target and to create a more sustainable balance of demand and supply in the Australian economy. The board expects to take further steps in the process of normalising monetary conditions over the months ahead, but it is not on a preset path. The size and timing of future interest rate increases will be guided by the incoming data and the board's assessment of the outlook for inflation and the labour market. The board is committed to doing what is necessary to ensure that inflation in Australia returns to target over time. And by the way, the RBA will publish its quarterly update of forecasts on Friday that's widely expected to show downgrades to economic growth and employment and a sharp increase in the inflation outlook in line with the Treasury outlook reported last week and the comments in this current release. So what do we take from that? Well, firstly, the chances are there will be more interest rate hikes, but they are going to be data driven. But they still believe that the economy is strong, that unemployment is very low, and that growth will continue. And it seems to me that they are still arguing that households have plenty of buffers, so there's nothing to see there. Therefore, the bottom line is you can expect higher interest rates. The market call of around 3% by the end of the year probably sounds to me reasonably okay, but of course that will have significant impact on households and their budgets, as well as small businesses. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.